Your market news now. Global stocks fell while gold rose after an aborted uprising by Russian mercenaries raised questions about the authority of Russian President Vladimir Putin. Gold, often perceived as a safe haven in times of geopolitical or market turmoil, rose 0.6% to $1,932 an ounce, adding to the sense of unease across markets with the latest travel figures from last week's holiday in China that were not as strong as expected, once again highlighting how the post-COVID recovery in the world's second largest economy is fading. Locally, South Africa's biggest cement maker, PPC, reported that its full-year loss widened as it was hit by volume declines in its key markets of South Africa and Zimbabwe. PPC's SA and Botswana cement business, which accounts for more than a half of group revenue, also saw volume declines of 5.8%, with the company saying that volumes in the coastal region were offset by continued weak trading conditions in the inland region. To talk to us about the markets, we are joined by Gary Boyson, who's a portfolio manager at Rand Swiss. Gary, thank you so much for your time. Your sense of the JSE's performance right now, given that our global peers are concerned about inflation, global growth, and even the possibility of a recession?
Yeah, so the market definitely on the back foot at the moment. So we've got the all-share index down about a third of 1%. Financial index was leading the downside, but the resources have just edged ahead. And I think it's just this idea that there's a lot of fear out there in the market over the, especially given the events over the weekend. I think the market's trying to digest what does this mean if we see, this revolt that is not a revolt happening. How is that playing through? We're starting to see oil prices pick up. We've seen natural gas prices also rising. And overall, it just seems like the market is striking a cautious tone. We've had a couple of results out that the currency is actually getting a little bit stronger. So we're seeing the US dollar weaken slightly, and that helped the South African rand to chalk up an 1858 handle. But the gold price also starting to rise, also on that slightly weaker dollar. So you've got 1931 on gold, and that's maybe a little bit of concern creeping into financial markets.
PPC earlier this morning released their results, reporting a full-year loss that has widened, also seeing volume declines in two of their key markets. What did you make of the numbers? And I suppose also to that question, has PPC ever been a stock that you found interesting before?
We've looked at PPC over the years, of course, but it's been a very, very tough environment for the business. As you can imagine, we've got weak growth, high inflation, which has created higher interest rates. That means that big building projects, certainly from the private sector, have become less attractive, less feasible. So they're facing a difficult time, and of course, load shedding is kind of hampering everyone. But if you actually look at the underlying numbers, cement volume was down around 5.8%, but they managed to push through price increases of around 8%. So, you are seeing a little bit of a stronger sales number there, but overall, it's just a very, very difficult environment. I mean, they have to get a big government infrastructure, program through to really turn things around. They're talking about tariffs. They compete directly, specifically in the coastal regions, with imported cement as well. So difficult, but even so, still deeming it worth rewarding shareholders with a 200 million rand share buyback, which accounts for about 3% of revenue. So yes, headline loss, but still buying back its own shares. So clearly seeing some value in itself, and that I think helping to just drive the share price up around 5% today.
When you look at the U.S. markets, I mean, is this a market that's been driven by fundamentals, or is the Fed back in the driver's seat?
I think the Fed is in the driver's seat. So we've seen a lot of rhetoric out of the central banks, but there's still an expectation that the Fed is going to hike interest rates one more time, and that's never going to be good for equity markets. So if you look at the Fed funds futures, there's around a 70% chance that we'll see a rate hike, another 25 basis points from the Fed in 1 month's time. So we've still got very, very tight, very aggressive monetary policy. And I think what everyone's going to be looking at is just how fast those inflation figures fall. The labour market is still remarkably robust given the speed at which the interest rates have taken place. And we're getting to the stage now where we should start to see an impact in the labour market. If we don't, then I think, financial markets in the US are looking very, very good. And from a fundamental point of view, we're still seeing, decent technological advances. We're seeing a big rotation back into the tech stocks, I suppose, with the anticipation that you're going to see interest rates falling, but also on fundamental changes to technology, that things like the rise of artificial intelligence. It's definitely got market participants excited.
So this week we have Naspers and Prosus releasing their financials. What's your view on those two companies, given that some analysts are saying, well, if you look at the trading statements that came out last week, it demonstrates the extent of which we've seen value destruction here by the management team?
But it's always a difficult one. So, if you look at institutional markets, and many analysts out there are incredibly critical of the management team in Naspers, as you say, pointing to the failures, in their investment thesis. The many companies that they've invested in that haven't become profitable, but and essentially just saying that Naspers and Prosus is a shell to enrich management, by paying them essentially the dividends from the underlying holding in Tencent. But from my point of view, I think that might be a little bit unfair. A lot of that is already in the price. And when I say unfair, it's unfair to look at the whole company and say, oh, well, this is not worth investing in as a South African investor. You've got to remember, even with the management team in place, and even with the so-called value destruction that everyone talks about, you're getting access to a very, very unique asset on the South African exchange. It is not easy to find a replica of that in our market, and at the same time, if you're looking for exposure into Tencent, it still represents a significant discount to buying Tencent shares directly. Now, that discount can easily unwind if you see changes in the management or changes in the strategy. So, from an investment point of view and from a value point of view, I think that there might be something there, despite the criticism that has been leveled against management.
Before I let you go, a key event that you're keeping an eye on for the rest of the week?
Oh, there's a lot of economic data coming out. So I think Friday is going to be the big one. So we've got US inflation data through the PCE, which we know the Fed watches. But we've also got the Eurozone unemployment and the Eurozone inflation numbers, which I think are going to be absolutely key, just to, I suppose, molding a thesis around, how much should you have in Europe, how much should you have in the US. South Africa, we've also got a couple of PPI numbers out on Thursday. And we've got a couple of central bankers speaking as well. So lots to keep an eye on the economic front.
All right, Gary, thank you so much for your time. That is Gary Boyson from Rand Swiss. And on the back of that comment about the central bankers speaking this week, the heads of major central bankers will be meeting in Portugal, and investors are expecting them to continue the rhetoric, saying that they are committed to tackling inflation in order for them to be able to deal with the inflation problem. But we might see aggressive interest rate hikes, but we'll keep you updated on all of that. That is it for me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.